Now, there's two aspects to that question. You use the word investors. Now, there's two sets of investors. One, it depends if you're talking about a foreign investor looking to buy foreign currency bonds, or a local investor that would be looking to buy local currency bonds. So, in fact, I'm going to split that question into two. So, the foreign investor looking to buy into a currency and is willing to take on a country's risk. Let's use one of the African countries as an example. Let's use Botswana. They would very easily be able to access the risk of the sovereign, much more easy than they can a credit of a corporate, right? So that is the primary reason why a foreign investor would much more easily be able to assess the risk, buy that note. First of all, there's generally a lot more liquidity in those bonds as well. So that element, those two elements are crucial for any investor, right? So, and then on the other hand, you get a local investor who sits with a similar sort of mandate restriction, is that they're looking to buy bonds to get a return, but naturally they have to assess the risk. Being a local entity, they probably would be able to assess the risk more easily. However, there's very few around. Very few of the corporates come to the market for reasons that it's probably quite expensive. They're not familiar with the process. There's not a lot of people like myself out there that actually encourage it. It's a timeless exercise, and typically the banks are very aggressive in that market and provide a very good set of financing. So those are the real reasons why, but I believe the more people like myself that are out there marketing to corporates, getting people comfortable with the process, the more corporates will come to the market, reducing the pricing and the cost, and then it becomes more familiar. So over time it'll improve, but for the time being, sovereigns it is, because it's just so much easier. In fact, there is an urgency. If you speak to every investor, their biggest criteria or problem is lack of liquidity. So from their perspective, they want liquidity, and they want it tomorrow. Liquidity comes from, first of all, you need a lot of issuance to take place, a regular issuance, a regular supply. That allows investors to have the confidence if they sell it, there's another tranche that comes out to replace that investment. At the moment, there's so few that come to market, they hang on to that particular that note or whatever it may be, means that there's no liquidity. It's generally bought on a buy to hold scenario. So liquidity is paramount, in fact. And again, that's why people go back to sovereigns, because there's generally a little bit more issuance, which allows for a little bit more liquidity. But there's definitely an urgency. And as time progresses, the more issuance that come to market, they will then probably insist that the banks or the rangers provide secondary market trading, which then again, if there's enough liquidity, will provide or allow secondary market trade. But my sense is there is an urgency. It's crucial. I come down here for two reasons. One, and the most important, is about sharing of knowledge. That's what, you're sitting with like-minded people, all with a similar view, and I don't sit through every single presentation here available. I'm quite specific at what I'm looking for. So I come down here, and in 2 days I'm able to hear and get a real feel of what people are genuinely wanting to do in Africa. In other words, there's investors, there's issuers, and there's obviously the regulators or governments that they all have an opinion at what they want to do in Africa. And then on the other hand, what I like to come here is networking. It's crucial. Within 2 days, I'm able to meet 20, 30, if not even 40 people. Some of them new, some of them old acquaintances that I've refurbished. So in other words, in 2 days, it's a very effective way of catching up, re-establishing ties, and meeting. I mean, I've got business cards in my pocket from 3 or 4 potential deals that are literally in 1 day. And that's the reality, that's the beauty of this scenario or this conference. I've been coming to these conferences for the last 10 years. The theme has been consistently the same. Africa is the new market, and it progresses slowly. So I think the key message would be for everyone not to lose hope. Sometimes we take 2 steps forward and we have 1 step back. The reality is there's advancement, even if it's staggered and sometimes a little bit slow. I think if you look back at all the developed markets, they all had, always in the infancy, they had to start off somewhere. And I think that's where African continent is at the moment. We're in its infancy. But 10 years down the line, people look back and say, okay, remember, yeah, there was only 2 or 3 deals a year, now there's 30 deals or whatever the number is. And that's the reality of it. It's a frontier market and need to be assessed as such, but there's an element of patience needed. And whether we have the age all the time or the patience remains to be seen.